All right, I think it's about time to get started. Jim, do you want to kick us off?
I'd love to. Well, thank you all for joining us tonight. This goes out to all of our friends in the Chicagoland area, as well as the greater Phoenix area. And welcome to our quarterly Partners in Growth series. As we enter the heart of our tax filing season, we felt that it was very timely to talk about all the changes that have been discussed at the government level and so forth in order to bring clarity to exactly what the rules of the game are. Tonight's topic is called 2022 Tax Season Outlook. What is next for the Buildback Better Act? And tonight's speaker is one of our amazing team members, Bethany B Ellis. Bethany joined the Apex team in 2019 and currently serves the role as tax manager, heading up our tax team. And she is really passionate about helping our clients achieve their life's goals and works to provide strategic and forward-thinking tax and financial advice. Bethany's focus is on tax compliance planning, research, and she also assists clients with various business advisory services. Bethany received a Bachelor in Arts degree in psychology from Aurora University and later pursued additional education in accounting and business and received her license as a certified public accountant. She began her career in 2007, managing financial operations for a small agricultural and commercial trucking business. She has since worked with several public accounting firms with an emphasis on providing tax services to high net worth individuals and their related business. She is a member of the American Institute of CPAs and the Illinois CPA Society and is a past board member of the Kendall County Fair Association. She currently resides in North Aurora with her husband, Joe, and they have been recently married in 2020. She has 2 Dachshund mixed dogs and who are not spoiled at all. At least that's what I'm told. I find that very hard to believe. Knowing Bethany, she probably spoils them to death. When not at work, she enjoys spending time with friends and family, gardening, traveling to warm and sunny locations like Phoenix, Arizona, which is where I'm at right now, and loves boating on Lake Michigan and with her husband's family. And they have a trip planned to go to Cape Coral, Florida. So I think that'll be fun after we calm down after busy season. But without further ado, I'd like to introduce Bethany B Ellis. Thanks, Bethany, and the floor is yours.
All right, thank you, Jim. Thanks everyone for your attendance this afternoon or evening. I know it's always exciting to take some time out of your day to talk about the thrilling world of tax. So I'm really thankful that you are all able to join us. So I will just kind of get started and I'm going to dive right into it. I did my best to make this presentation a little bit interesting, a little bit at least amusing in some small pieces if I could. Just obviously tax can be a slightly dry topic, but I wanted to kind of give you guys some entertainment this afternoon. We're really excited that you guys are all joining us and hope that you find value in our discussion. So let me get my screen shared and we will get started. All right. So I think it goes without saying that, our tax landscape overall has experienced pretty constant change over the last several years. And as kind of Jim set up for us, there's additional tax changes on the table. Most recently, one of those changes that we've probably all been hearing a lot about is the Buildback Better Act. So we're, again, thankful that you're able to join us. We're going to kind of break down that Buildback Better Act and talk a little bit about what it means for you and what it might mean for your business. If anything, at this point, we'll get into that a little bit more further down the line. I did want to point out one thing, this presentation and all of the information that we're providing to you guys today and that we're talking about, it's really not intended to be in any way political in nature. We just kind of wanted to bring everything to the table, kind of cut through the noise. There's a lot of information out there on the media a lot of, Facebook articles that people are sharing and things like that. So it can be difficult to really get to the meat of the issue and figure out kind of what is the facts. So that was kind of our goal today in bringing this presentation to you. So, all right, so what are we going to talk about? Another tax season is here. So we thought that it would make sense, like I said, to start out the year with a discussion of the ever-changing and evolving tax landscape. So in order to do that, to kind of bring us to where we are today, I thought it would make sense to look at the history of taxation a little bit. I won't go too deep into that exciting topic for you, but I did want to just kind of touch on it because I think it speaks volumes about where we are today. So we're going to talk a little bit about where tax came from in the United States, how we got here more recently over the last few years, and then kind of where we're heading in 2022 and for the future. So I just kind of outlined the general order that we're kind of going to go in here for a conversation. So I guess that brings us to our next slide, which is why do we have taxes? So I think that's a pretty easy one, but just to kind of start us off, as we all know, taxation is really inevitable because it is the primary source of revenue for most of our government. The money is spent to improve and maintain like public infrastructure. It goes towards funding public services, towards schools, property taxes, all sorts of things like that, welfare programs. And many of the basic tax types that we have been around since early civilization. So it's nothing new. It's nothing new to the United States, but it's nothing new in general. In the US, income taxes amount to about 50% of the overall federal revenue. And then for states as well, it's a huge source of revenue for states. They're at about 15%. So definitely important to have taxes as much as we may not enjoy them at all times. Benjamin Franklin has been quoted to have said that in this world, nothing is certain except death and taxes. And, I think in a lot of ways, those words still ring true today. Like I said, well, the taxation in the United States has changed significantly over time. It's always existed in some shape or form since really the beginning of the United States. On the flip side, while they've always existed, they have not always been this complicated. So in the current tax landscape, the taxation in general is extremely complicated. And, as you guys probably have grasped over the last couple of years, especially, it continually keeps just evolving and changing. So like I said, I think in order to really understand and get like a good feeling for why or how significant the magnitude of change has been over the last, maybe say 5 years, I think it's helpful to kind of look back historically and just see, has this always been the case in the United States? Have we always had huge tax overhauls every 5 years? I think some of those changes, we'll look back in the history a little bit. Some of them have been gradual. They've been responses to different societal changes or economic changes, but others really were traceable to very specific historical events. So taking us all the way back to kind of the start of the United States, again, I won't go into too much detail here for you guys, but, like I said, taxes have always been around, ever since colonial times. They've been out there. We look back at the American Revolution, we can all think of that, very common quote, the no taxation without representation. That would kind of be like a key event in our country's history is the becoming of the United States, in that there were a lot of concerns between Britain and the United States over how the colonists were being taxed. So a lot of those were the very, very beginning. The American Revolution, like I said, was a key in that event. Then we had the Constitution signed, and about 100 years after that, we came up with the first income tax. The first income tax actually took place right around the Civil War, and it was a result of the Civil War. Abraham Lincoln signed an act because of the fact that he needed funding for the Union war effort. So that is where our very first income tax came from. It fortunately or unfortunately, I guess, did not stick around for long. There were issues concerning whether or not it was constitutional. The tax was repealed. There was another tax that was, again, tried to be added on in 1894. So a lot of back and forth. And then eventually the 16th Amendment came to be. So in 1909, the 16th Amendment was passed and it was later ratified. And this basically just gave the federal government the ability to tax, the individual personal income and corporate income as well. And then at this time, that was when the first 1040, which is the individual tax form, came about. So I came across that little tidbit of information as I was looking, researching a little bit for this discussion. I thought that was interesting. That first Form 1040 came about back in 1914 and was, I believe, 3 pages in length. The instructions were only about 1 page versus, now we have, I don't know if it's 115 pages or so of the individual tax instructions. So it definitely has been some change in that area. But anyway, following, the 16th Amendment, that was really when the first income tax, I guess, as we know it, came to be. The lowest rate at that time was 1%, and that was on incomes at a very, pretty low level. The highest marginal rate then was 7%. So there were actually very few Americans that were impacted by tax at that time. And then as we move forward in time, World War I took place, World War II took place. Throughout all of those events, tax rates fluctuated, as economic changes took place, tax rates would be driven up in order to fund things like the various wars. There would be other, tax decreases over time when the exemptions would be added. It just had a lot to do, like I said, with economic just kind of temperature at the time. And even by like in the World War II area, the top rate was 79%. So huge differences in the tax rate. When you think about, we started with 1%, and then by World War II, we were at almost 80%. By the time Reagan took office in the early 80s, I believe the highest tax rate was somewhere around the 50% rate. So I've just kind of got a slide here that shows you, over time, again, just kind of take a minute and look at that and think, our tax system has been around for a relatively short period of time when you really think about it. But as you can see, there's significant fluctuation. And so much of that is driven really by economic and political change. You can directly correlate some of these ups and downs in the tax rate to what was happening in the country at that time. So I think it's really interesting. And again, I think it's really important when we're talking about where we are at today in the tax landscape to kind of look back historically. And it really gives you a broader understanding of what drives tax legislation in our country. Having said that, the difference between death and taxes is that death doesn't get worse every time Congress meets. I guess that's not a very fair statement. I guess it doesn't always get worse, but taxes do seem to get additional complexity, especially in recent years. Every time that we hear about a new bill or something that new that's gone into Congress, oftentimes that means that taxes are going to get worse, or if not worse, at least more complicated. So a lot of changes have taken place over the last couple hundred years, but the last 30 years has been really intensive in tax change. Now, going back historically, the last really major reform to the federal income tax system in the United States took place a little over 30 years ago. This was the Tax Reform Act of 1986. I'm sure a lot of us remember that, or have heard about it, or read about it, or learned about it in our classes. The goal of this Reform Act, of course, like I think a lot of tax acts, are to, quote, simplify the income tax code. Whether or not it always takes place that way is, everybody's guess, I guess. But the main reason why Reagan was looking to pass this act and to simplify the tax code, he wanted to implement a system, and of course his administration and Congress, they wanted for all the taxpayers to pay their fair share. There were about 300 provisions that were within this act, and it was carried out over about 3 years. So like I said, when he took office, the top tax rate was somewhere around 50%. And by the time this act was carried out, it was down closer to 28%. For corporate, some of the tax breaks that had been implemented for corporations were actually reduced. This also marked the time for the IRS that they were starting to do some electronic filing. So obviously not a full implementation back in 1986, but it was when the IRS was really starting to get a little bit into the electronic computer-driven systems. So now we are at the 90s and 2000s. Again, I'm not going to go into the details of each of these different acts, but you can see here just in a very short period of time, or relatively short period of time, about 20 years or so, we see multiple acts being passed through Congress that, obviously each one of them came with significant tax change. When first President Bush was in office, the tax rates began inching up. He had promised that there wouldn't be new taxes, but they ended up getting raised in order to reduce the federal deficit. Then, under Bill Clinton, the tax rates went up. They were all the way up to, I think, 39.6 was the highest rate at that point. Clinton then in 97 had some tax breaks, which reduced taxes, so on and so forth. George W. Bush had a couple big tax cuts back in 2001 and 2003. These items significantly changed a couple of different things, changed some tax rates, some tax brackets, made a significant change to the child tax credit and several other like education expense deductions and things like that. So definitely a lot of change there. The Bush tax cuts did benefit high income taxpayers the most, and they also led to some increased deficits, according to the Center on Budget and Policy Priorities. So as you can see, all of this just kind of goes to show that there is significant fluctuation over time. The last note of, kind of like that 1990s, early 2000s era was with Obama. Many of Bush's tax cuts were extended during that time, and that was also when the Affordable Care Act came about. So the Affordable Care Act, I'm sure as many of us know, brought about a lot of change to tax law, especially as it relates to health insurance and hospital insurance tax, Medicare tax, things like that. So that brings us a little bit more recent. So again, that history was intended to really kind of give you guys an idea of what tax law fluctuation has looked like since the beginning of the United States, but more specifically over the last 50 years or so. And we've kind of gone all the way up till now, we're at about 2017. So in 2017, we had a significant package passed by President Trump, which was the Tax Cuts and Jobs Act. And I'm sure this is something that you've all heard about in recent years, and it's definitely something that's a little bit more of like a common word or common phrase that lots of us have heard tossed around over the last few years, as it really was. It was like the largest tax reform in over 3 decades, really, since that last 1986 change that I mentioned. So Donald Trump did claim that these were the biggest tax cuts in history. According to the Committee for a Responsible Federal Budget, the Trump tax cuts were actually number 4 in inflation adjusted dollars. So while it wasn't the biggest, it certainly was very high up there. So it certainly made a lot of changes to a lot of different areas of our tax code. Some of the goals that were intended for the Tax Cuts and Jobs Act included relief from taxes for specifically like the middle class. And then again, this was also an act that one of the goals was to simplify overall like the tax code, especially for individuals. There were also other not as tax specific goals, or they were more of like a byproduct of some of the tax changes, hoping to stimulate the economy and stimulate some of the income to come back to the United States from overseas. So definitely had a lot of goals. Most of the changes that took place as a result of the Tax Cuts and Jobs Act, they applied to years starting after the January 1st, 2018. So the 2018 tax year was really our first year with most of these changes. And then a lot of those changes are permanent, especially like the corporate changes, but a lot of the individual changes are actually scheduled to a sunset period in the end of 2025, which basically just means that they were temporary tax changes that are subject to go away if we don't have any significant change that changes those sunset dates between the passage of the Tax Cuts and Jobs Act and that sunset date. So just to kind of give you a high level overview, I guess, of the TCJA, I wanted to kind of review some of the more high level tax law changes that took place as a result of the passage of that act. Because it's a lot of buzzwords, a lot of buzz phrases that have been going on in the last couple of years. And it's honestly a lot of new tax law that many of us are still getting used to those. So it's important to kind of recognize what came about from that change, that act, that passage versus what's kind of come about from some of these more recent things. So very, very high level. I'm not going to go into super detail about the nitty gritty of these tax laws, but some of the items that changed, the individual tax rates across the board. The top marginal rate, so the highest individual rate for married taxpayers prior to this passage of this act was 39.6. TCJA brought that down to 37%. There were many changes to the individual alternative minimum tax, and it also eliminated the corporate alternative minimum tax. The personal exemption. So, prior to TCJA, there was a personal exemption for yourself, your spouse, your children, things like that. Those were eliminated. Well, they were suspended for the TCJA, and they were replaced with this larger standard deduction that was hopeful to further simplify taxes, as more taxpayers, because of the higher standard deduction, would hopefully be using the standard instead of using itemized, which the itemized deduction would be, your Schedule A, where you've got your real estate taxes and your mortgage interest and things like that. So by increasing that standard, the hope was that it would be simplified, that fewer taxpayers would have to itemize, but they would still be getting a significant benefit there. It also changed a lot of our personal itemized deductions. There were a lot of different things that kind of fluctuated based off of this change for personal individual itemized deductions. That would include probably the most, famous or the most infamous, if you will, is the change to the state and local tax deduction. A lot of you have probably heard us refer to the $10,000 cap. So prior to the TCJA, you could deduct generally speaking, unlimited amount of your property taxes plus your state income taxes. And this TCJA implemented a $10,000 limit for all of those taxes combined. So that really made a big difference to a lot of taxpayers, specifically those of us in higher tax states, or especially high net worth individuals that paid a lot in state income taxes. If somebody was paying 50, 60, 70,000 in taxes between their real estate taxes and their state income tax, to have that go from being allowed to have that whole amount down to only the 10,000 was a pretty significant adjustment. There were also other deductions that were eliminated for itemizing things like tax prep and unreimbursed business expenses. Those got the boot. Mortgage interest limitations changed, just some of the mechanics on what type of mortgage interest and how much of it you can deduct. That changed. And then it also changed how alimony would be treated for new divorce agreements only. So a couple of changes from the Tax Cuts and Jobs Act. Continuing on, the corporate tax rate. This was a huge one. The previous top corporate rate was 35%, and this act brought it down to 21%. So that was a very large change. That really was meant to kind of equalize the corporate tax rate with the pass-through entity rate, which was changed by this act because of the implementation of what's called the qualified business income deduction. So this is a QBI deduction, and basically that is just what it sounds like. It's a 20% deduction that's allowable on like self-employed income, small business owner income. So for a lot of pass-through entities, they were able to take advantage of this 20% deduction. So to kind of equalize that with a C corporation, that's where the C corporation rate came down. There are, of course, exceptions to every rule. So not every business owner was able to take advantage of this, but generally speaking, it was available for the qualified business income. Other changes to the way that we were able to handle and deduct net operating losses. The individual mandate under the Affordable Care Act was repealed, which was a penalty that was implemented if you did not have qualifying minimum healthcare coverage. You were actually penalized on your tax return for that lack of coverage, and that was repealed. The estate tax exemption, that's another very frequently spoken of change that came as a result of the Tax Cuts and Jobs Act, was that the estate tax exemption was raised temporarily, but from around 5.6 million all the way up to 11.2 million. So that was a pretty significant change. Definitely changed things for those that were, involved in estate planning, or even to this day are continuing to work through estate planning. So change to the estate tax exemption. And then of course there were various international tax changes that we could probably go on about for hours and hours, but I will spare you from that excitement. So, all right, so we had the Tax Cuts and Jobs Act, we got through that, and we thought we were doing well. As tax professionals, we had kind of gotten our handle a little bit on some of those changes, and we're starting to feel kind of confident, kind of comfortable. And we were in the midst of tax season, 2020, and COVID came to be. So in January of 2020 is when the WHO announced the mysterious coronavirus related pneumonia. And with that, I don't have to tell you all the history, very, very quickly progressed to a point in mid-March where, COVID-19 had been declared as a national emergency. It was a pandemic. And that was kind of the start of a whole new era, I guess. Now, obviously, I think that it goes without saying, COVID was disastrous for many, many reasons, more so, significantly more so, so much more so than it was for tax law. But for the purposes of this discussion, I'm focusing only on the disasters and the things that took place in regards to taxes. So I'm not really going to go into the details of overall, the pandemic and the timeline and things that have happened with that, really just more focused on the tax law and legislative changes that took place as a result of COVID-19. So just to give you a really high level kind of overview of it, there were a lot of different supplemental funding relief efforts that came to be as a result of COVID-19. I have listed them out here for you just so you can see at a high level. There were a lot of changes coming, pretty quickly. Just in 2020 alone, we had 6 significant pieces of legislation that were passed, all of which had their own unique pieces and tax law changes, and of course all of these, there's significant other provisions that were included in them as well to offer more economic assistance for small businesses, for American workers, for families. So it wasn't, of course, just specific to only tax law, but again, for purposes of this conversation, that's our main focus. So excuse me, just to kind of go back to some of the beginning ones, these packages were really large. Some of the earlier ones didn't have significant tax provisions within them, but even just, within the first couple of weeks after the pandemic had been declared, there were some legislative packages that were being rolled out, like the Families First Coronavirus Response Act, that had some pretty important tax items in it. This one that I just mentioned came up with emergency paid sick and family and medical leave. There were payroll tax credits, increases to unemployment benefits. So there were a lot of changes that were coming forth from these that, the intent was to kind of help provide relief domestically for emergency funding, but had a significant impact indirectly on taxation as well. This next one is the Coronavirus Aid, Relief, and Economic Security Act, which is known as the CARES Act. And I think this is probably one of the more commonly known kind of household names that a lot of us, have heard a lot of information about. This was the most expensive single spending bill ever in American history, about $2.2 trillion rescue package that was implemented. Quite a few important tax provisions within this act. Recovery rebates or economic stimulus payments for individuals. That was when that was first kind of rolled out. There was a penalty waiver for those that maybe had to take money out of their retirement accounts for certain COVID-related reasons. The penalties that would usually apply to early distributions were waived. There was no required minimum distribution required for 2020 for qualified retirement plans. Another one was that a $300 above the line deduction was created for charitable contributions. So that was kind of a nice addition, just gave everybody a little bit extra tax benefit. If you weren't itemizing, you could still take advantage of some of those contributions that you'd made to charity. So it was a little bit of a tax break and also a little bit of a motivator to, contribute to your charities and help people out in times of need. So those were the individual provisions, or in a very, very small nutshell, some of the high level ones. There were many others. Corporate tax provisions, there were some revisions to the net operating loss rules. There was also a change to the qualified improvement property. One thing, going back to the Tax Cuts and Jobs Act, there was a technical problem with one of the changes there that limited the way that we could deduct the qualified improvement property, which is similar to a class of property that used to be called leasehold improvements. And there was a change that came about with the CARES Act that allowed us to deduct that again. So that was a welcome change, something we've been waiting on. And then there was also payroll tax relief for businesses. And another really important thing that took place as a result of the CARES Act was that the SBA was authorized to establish the Paycheck Protection Program. So PPP was obviously, and still is obviously, extremely important. It helps businesses, to receive funding so that they can keep their businesses open and pay their employees. And then with that, it brought a different layer of complexity to the tax code because, obviously we had to account for that income for all of our business owners. So definitely a lot of things to consider there. Moving on, there were a couple changes to the Paycheck Protection Program. Not going to go into detail here, but obviously, just kind of to let you know, like there were many acts that took place that made some changes there. Later in December 2020, we had the Consolidated Appropriations Act. This was a huge bill, but a lot of it was focused on COVID relief. I've just got some of the changes listed here. One of the big ones that came about from that was that it allowed a deduction for the expenses that were paid from PPP funds. So as a lot of you probably remember, there was a scary time there where we were under the impression, based off of the IRS guidance, that we were going to have to advise our clients that the PPP funds were taxable and that there was no deduction for those expenses. And thankfully, this gave us a little bit of guidance and clarity in that regard. Another change was for 2021 and 2022, it allowed a temporary 100% deduction for meals. So those were only meals that were provided by a restaurant, but it was a departure from prior tax law that was 50% deduction for any meal. So that was kind of a nice deduction for business owners. And also it was intended as like an incentive for all of us, especially businesses, to spend money at restaurants and hopefully support small businesses. So we have that. Let's see what else for the Consolidated Appropriations Act. Like I said, there's a lot more changes here. I'm not going to go into detail on each one. Next, we had March of 2021. This is the most recent, the American Rescue Plan Act. This was also a very, very large package. It was signed into law by President Biden. And the intent really of the American Rescue Plan Act was that it would help to speed up the country's recovery from COVID, basically. All of the economic effects that took place, all of the health effects, it was just really intended to help speed up the recovery from those things and then kind of speed up or eliminate as much as possible the ongoing recession. So a lot of this act really is just building upon like the measures that were in the CARES Act already or in the Consolidated Appropriations Act. A lot of key ones though, there was round 3 of the recovery rebate payments. So the economic stimulus payments that were paid out to many individual taxpayers, across the United States. It extended the federal unemployment benefit that had previously been set to expire, and then it also made a portion of that federal unemployment benefit not taxable for 2020. So it was about, I think, $10,200 for certain taxpayers. Those whose income was under a certain threshold were able to treat that first about $10,000 as not taxable. So just another kind of stimulus item to help people during this difficult economic time. The American Rescue Plan Act also made other changes. It provided a tax credit to employers for sick leave and for the family leave benefits, expanded the child tax credit. This was really the change that's responsible for the advanced child tax credit that I'm sure you've all heard about this one. Starting in July of 2021, taxpayers were receiving advanced payments, and those advanced payments were really a tax credit for 2021 And it was just kind of received in an advanced fashion, and then that will actually be reconciled on the 2021 tax return. So quite a few changes took place from the American Rescue Plan Act. So with that, we've kind of gone through the history, we've gone through the Tax Cuts and Jobs Act, we've gone through all of the COVID related legislation. And that really brings us up to kind of more like current day. So the next big topic, I think that is, our title topic of our presentation is the Build Back Better Act. So what is the Build Back Better Act, and basically where is it at? What's the status of it? So this is, a huge spending bill, about 1.7 trillion, and it had passed the House in November of 2021, had gone to the Senate and is currently still stalled in the Senate. There were a lot of different goals that, I'm sure we all heard in various news outlets or again on our Facebook feeds, at the dinner table maybe. This was such a massive spending bill, and it had a lot of different goals, a lot of really like new ideas, and some of those included things like the national 4 weeks leave program, or free universal preschool. Again, additional expansion and extension of like the child tax credit changes. And then in addition to that, it was really focused on providing or putting in place ways to provide for affordable health care, affordable housing, things like that. So lots of big goals. Some of the key tax provisions. Now it's important to remember, like I said earlier, this Build Back Better Act, or BBBA, or it is currently stalled. So I'm going to go over some of these potential tax provisions because I think it's important to identify what they are and what they were, and if they're real, if they're happening, or if they're stalled. So keep that in mind, that the provisions that I'm talking about now are not actually, they haven't actually been signed into law, and they are not necessarily going to be, as the current legislation is kind of on hold. So there was going to be an expansion of the net investment income tax. That was a 3.8% tax on a lot of investment income for some higher net worth taxpayers. Like I said, the child tax credit or an income credit, those were looking to be expanded, as was the healthcare premium tax credit. Another big one is that there was going to be a lot of extension and also expansion of green energy incentives and like electric vehicle credits. And then also one that I think was very much talked about was the increase of the SALT deduction. So I had mentioned earlier, talking about the Tax Cuts and Jobs Act, that $10,000 cap that had been placed on the deduction available to individuals for their state and local taxes. There was provisions in place that would increase that $10,000 limit. At one point it was up to $80,000, and it kind of fluctuated based on different versions, but the idea was that that cap would be increased. There were also a lot of other things within the act that were intended to help with compliance and IRS enforcement. So what is next for the Build Back Better Act? Here is the meat, I guess, of our presentation is, unfortunately, the answer is we don't know. There really isn't a great answer to that question yet, because there's not currently a clear timeline for its passage. We really don't know if or when that Build Back Better Act is going to pass, but I do know that there are currently no official negotiations underway. It's been referred to as dead by Senator Joe Manchin, who is really the biggest roadblock to the bill passing through the Senate. So currently, the expectation is that it most likely will not pass in its current format, most likely will not pass with its current name. A lot of the items that are in it, a lot of the provisions, a lot of the things that are really important within the legislation may very likely come back in a different format. Some of the programs may be scaled down so that they're a different, financial threshold. Some things could certainly be eliminated, but we really just don't know the answers to all that. And another important kind of note in that respect is that we don't have an answer to whether or not it could become retroactive. I think that's always a consideration, is when there's legislation pending for tax law change, the hope or the best case scenario is that it would take place for a future year. And kind of the worst case scenario, at least from a planning perspective, is that it would take place for a previous year. And that is something that we've seen happen. And, historically, it's not incredibly common, but it could be a possibility. So it's something that we'll continue to kind of monitor. Just kind of in reading, trying to scour the internet for just kind of some notes on the Build Back Better Act and the status, and trying to get prepared for the conversation today. It just really was a recurring theme that there's so many other national issues that are out there right now. When the Build Back Better Act was originally pushed forward, the country itself was in a very different spot. I mean, even if you think about summer of 2021, the economic uncertainty and a lot of the things that were taking place were just very different than the climate that we have today. Unemployment, for example, if we talked about this a year ago, the situation surrounding unemployment rates, inflation, things like that, that conversation would have been a very different one than it would be today. So a lot of those factors are going to go into if and what another package might look like. It is important, I think, to note that this Build Back Better framework was really a very key part, actually, of Biden's presidential platform. So it's most likely going to come back, at least in some iteration of itself in the future at some point. So that brings us to, well, if the Build Back Better Act is not going to become tax law, at least not for right now, well, where do we currently stand? So these next couple of slides are just intended to give you an extremely high-level overview of where we're at for 2021 tax returns. Like I've mentioned, there's a lot of changes that came about for 2021 that were based off of the previously passed legislation. So talking about a lot of those COVID items, the stimulus payments, changes to the child tax credit, the above the line charitable deduction, a lot of those things, while they took, the legislation was historical, like a lot of the changes are actually going to be ones that we see happening on the 2021 tax returns. So that's going to be very, very important. I know we have changed a couple of things in the way that we're getting information from our clients, the things that we're asking for, just to make sure that we're getting all the right information about those stimulus payment numbers, or whether or not they did receive the advanced child tax credit payments. So that's going to be really important to us this season. Other than that, you've got your normal adjustments for inflation every year. A lot of different items are increased for inflation, whether that's deductions or income tax brackets, things like that, different deductions and credit items as well. So inflation items will happen. There's also some things that are set to expire. Like for instance, that penalty waiver that I mentioned in regards to retirement distributions, that one will be going away. So a couple changes there. We're also really encouraging for our clients to all set up the Irs Gov account. And this is just like an online account that any individual taxpayer can set up. And the key reason why we're really encouraging for all of our clients to do this is that, as I mentioned, there are some specific items that we're going to have to reconcile in the 2021 return, like those stimulus payments, like the advanced child tax credits. And unfortunately, the best information that we can get is by having you set up this account and download the history. It helps us kind of identify if there's any discrepancy between your records and the records that the IRS has. So that can be hugely important. I skipped one here, but the estate tax exemption has also changed for this year. It's gone up for inflation. So that is important. And as I said earlier, that's going to be reducing in a couple of years if there isn't any additional legislation. There's a couple items for business tax returns that are changing significantly for 21. So there is a new form K2 and K3 that is being required for some foreign reporting on pass-through entities. So these forms would basically be intended to report to the IRS any foreign activity that the shareholders had. Now there was just today actually a new FAQ that was issued by the IRS that gives us a little bit more guidance on how we have to treat this, because unfortunately these forms are 20 to 30 pages long and require significant information to be included on them. So we're really excited that this FAQ was issued, because I believe it's going to provide us a little bit of relief, and we're not going to have to file that on as many business returns as we had previously thought. So that should be good. Other than that, there's some changes to the way that we have to report S corporation shareholder basis. There was a change to partnership basis reporting last year. So this one makes a lot of sense, but hopefully it won't really require much other, as long as we've been keeping good records regarding basis, we should be in a good spot. Other than that, we've still got that 100% meals deduction. We still have the 20% qualified business income deduction available to us for our pass-through entities. So we will still be taking advantage of that for any businesses that qualify. One other key thing to note is that, there's been a lot of talk about the employee retention credit. And I know that we have a lot of clients that are getting a lot of benefit from taking advantage of that credit for either 2020 or 2021. And one important thing to note is that based on current guidance, we may have to amend some prior returns if there is a 2020 credit. So basically the IRS has said, hey, if you get this credit, even if you don't receive the credit until 2021, by amending your payroll tax returns to take it, we still want you to fix your 2020 return to reduce the expense that you claimed for payroll expenses on that year. So that's going to be something that we're considering as we work through our 2021 tax returns. Is there any need for an amendment of a prior year return because of that employee retention credit? And then also we may have some considerations for 2021. Do we want to extend the returns just to make sure that the amounts that are ultimately received by the client for that credit are the same as what the payroll tax return reflected when they applied for it? So we will definitely be monitoring that. Another huge area of significant change, and something that I think is really important to continually consider, is changes in the state and local tax area. So this is something that I'm sure many of us have heard in the last couple of years. You've heard the word Wayfair tossed around, and you've heard that state tax requirements are getting a lot larger and more detailed. And I think that's very, very true. No two states are the same, unfortunately. I wish that it, could be said that, well, whatever Illinois taxes ABC income as is the same as what Minnesota would, or the same as, whatever other state. But unfortunately, like I said, no two states are the same. There are a lot of possible state tax consequences and, maybe possibly a filing requirement due to this evolution in our tax law. Another thing that has significantly changed this is the pandemic itself. Basically, as we all know, a lot of us transitioned to working from home because of the pandemic. And with that, many employees worked in a different state. They took advantage of it and said, hey, I'm going to go work from Florida for a couple of weeks. Or, maybe they were working over a state border. So when they went to work from home, they were working in another state naturally. But just some of those changes really have created a lot of question marks. So and I think with that, it's also increased the kind of scrutiny that state tax departments are using to look at these sorts of things. Obviously their goal there, as I mentioned earlier, in having these taxes is to generate revenue. So any way that these state revenue departments can find to bring more revenue into their state is something that they're going to want to do. So definitely very, very important to just kind of identify any tax consequences that you might have from additional state activity. And of course, we can help with that. We're happy to do that. I am running a few minutes late here, David. Am I good to just go a couple more minutes later? Okay, I'll try to wrap it up here for you guys, but there's just so much exciting tax stuff to talk about. I can't help myself. Okay, so another thing with state and local taxes that's very important, I think, to keep in mind are what's known as federal conformity issues. And that's just a fancy way of saying, does the state treat that item the same as the federal government does? So a perfect example of that is depreciation. A lot of us are familiar with the concept of accelerated depreciation. You can take 100% bonus, or you can take Section 179. So the federal government gives us the ability to take that deduction in full in year one on certain qualifying property. So the question is, that's how the federal government treats it, but does the state treat it the same way? In some cases, the answer is yes. In other cases, the state has decoupled or moved away from that federal procedure, and they handle it their own different rule. So that's something that's important to keep in mind. Depreciation, CARES Act changes, the PPP loans, each state gets to kind of identify how they're going to treat those items. So very important to, take that into account when you're doing tax returns as well. Finally, the state and local tax deduction. As I mentioned, there is the individual SALT deduction that's capped at $10,000, which really was limiting to taxpayers that had significant tax bills to especially high tax states. So something that the states have come up with over the last couple of years as a workaround is having those taxes be paid at the entity level. So this is essentially, it's essentially going to be the same as paying the shareholder tax, but rather than having the income from that pass-through entity flow out to the shareholder and then being paid on the shareholder's individual tax return, what will happen if we elect to take this pass-through entity tax instead is that the business entity itself, pass-through entity, will actually pay the tax on behalf of that shareholder. And what happens then is that the business will be able to take a federal deduction for the taxes that it's paid. So there's some, various considerations. Again, like I said, no two states are the same. So in this, no two states treat these exactly the same way, but we do have the ability to, kind of look at some of these pass-through entity taxes that have been created in the last few years and see if it makes sense to get additional deductions by utilizing this as a method for a lot of our business taxpayers. So we're really hopeful that that's going to bring some significant savings. So real quick, I just wanted to touch base on a couple of state-specific updates. So I've just got a couple things for Arizona. Arizona has actually had quite a few significant tax changes come to be, or at least get put into place over the last year or two here. One of the most significant of those is for individual taxes. They are actually moving from a bracketed system of 4 individual tax brackets. From that system, they're in the process of transitioning to a flat tax. So that transition is set to take place over a period of years. The goal, I think, of which is to have it in place by 2023. It'll be a flat 2.5% tax versus I think their highest rate currently is about 4.5%. So that's a pretty significant change. And it's going to take place, like I said, over a period of time. 2021, there's also a change called a high earner surcharge, which is going to be assessed on individuals with taxable income higher than 500,000. Now there is kind of a workaround that's been put in place for that. For those of us or those individuals with pass-through entities, there is a small business income tax election that was signed into law back in 2021, which is basically going to allow for individual taxpayers to elect to have their Arizona small business income taxed on a separate return. So in adding in, that election, it's kind of limiting it from that high earner surcharge. So the goal there is that small business income won't be subject to that extra surcharge. So it'll be kind of capping the overall tax rate that it's could be taxed at. So that could be good for small business owners in Arizona. Another key change for Arizona is when it comes to economic nexus, which is basically related to, do I have to file an Arizona tax return? Do I have to file an Arizona sales tax return if I'm selling to Arizona customers? There were some changes here in the threshold. So very, very important if you are selling to Arizona customers that you're aware of that change and can adjust accordingly for your sales tax returns. This brings us to Illinois, who luckily didn't have quite as many changes as Arizona for the 2021-22 year. Illinois is still a flat tax rate of 4.95%. The exemption this year has increased a little bit to $23.75 per person. Nothing new there. Qualified retirement income in the state of Illinois is still non-taxable, so that is still in place and is good for those individuals with any kind of like pension or Social Security income, things like that. Illinois is one of the states that has a pass-through entity tax election. So as I kind of mentioned earlier, as a workaround to getting an additional deduction for your state taxes, Illinois has implemented a pass-through entity election for partnerships and S-corps for the 2021 tax year. So we will be identifying that on our 2021 returns to make sure we're taking advantage of that for our Illinois small businesses and pass-through entities and things. Now with that, Illinois did decouple from the federal treatment of bonus depreciation, which, like I mentioned earlier, simply means that, well, the federal government is letting us take that 100% deduction up front in year one. Illinois says, no, 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 we don't want you to do that. We're going to make you add back some of the depreciation and take it over a slower period of time. So, we're going to do our best to kind of work around that limitation and hopefully be able to use some Section 179 depreciation, but it's something that we are aware of for this year. Other than that, I think I've kind of hit on all of the Illinois updates. Moving forward, we're getting close to the end here, but something that I felt remiss, I couldn't end this presentation without talking a little bit about, because I think it's extremely important to our clients and just to taxpayers in general, is the IRS. The IRS, obviously, Internal Revenue Service. I don't necessarily know that any of us would probably say that their customer service has ever been, 110%. But I do think in prior years, we've had a lot of an easier task at hand in dealing with the IRS, whether that's in, sending them a return to get processed or reaching out to them on the phone to address an issue. In recent years, because of the coronavirus pandemic, so many of the IRS's employees were working from home. Their productivity just plummeted, really. It just went down significantly, and they really have not had an opportunity to fix that yet. And then in addition to that, all of these tax law changes that we've talked about, starting with really the Tax Cuts and Jobs Act, and then followed not too soon after by all of the COVID legislation, there were a lot of changes that had to take place at the IRS level in order to account for these things. I mean, even something as simple as, the economic stimulus payments, that required the IRS setting up a whole new system, figuring out who was eligible for them, figuring out who had received. So they've had a lot of new things added to their plate, I guess, in the last year or two here. So I can feel a little sympathy for them, but unfortunately, that does mean that they're just really continuing to experience huge backlogs and delays. A recent taxpayer advocate report came out that said there were something like, I think, 23.7 million unprocessed 2020 returns alone. And that's not to mention, other amended returns. Of the 282 million phone calls that were received in fiscal year 21, only about 11% were actually answered. So if that can give you just a little bit of an idea of kind of how the IRS is currently functioning, it certainly is a challenge that we are doing our best to overcome and to still be able to, provide information and relief to taxpayers as we work through various issues for them. But we would just, continue to ask for patience from our clients and for some grace there. Luckily, recently, February 9th, the IRS announced that they are going to put an automatic hold on certain notices. So we're hopeful that just that in and of itself will maybe minimize some of the correspondence that's getting sent to taxpayers, which of course can create significant stress. You get an IRS notice and it's a very stressful event. So we're hopeful that this hold that the IRS has announced will kind of help to mitigate that so that the IRS can catch up, taxpayers can catch up. Across the board, the situation is just really not great. So we're really hoping in the next 6 months or a year that maybe the IRS can catch up a little bit with itself. One key thing I think that's important, I mentioned this a little bit earlier on the advanced child tax credit, is it's important to make sure that we're recording the correct amounts for that credit if somebody received a payment in advance, like over the year. The IRS had implemented a system whereby they were going to send out this letter 6419 to every taxpayer that received the advanced child tax credit. So they did send that letter out. And unfortunately, we've now found out that there are some pretty significant errors in some of those letters. It sounds like some of the letters were maybe sent before one of the payments had actually processed. There's some taxpayers, I believe, that are married that are receiving a different letter for each taxpayer, both the husband and the wife, and that is just causing a lot of confusion. So I bring that up only to say, again, I can't recommend enough to you that if you have any kind of child tax credit, or if you got a stimulus payment, or honestly, even if neither of those things applied to you, but you have to pay tax to the IRS, getting that Irs Gov account can just be extremely helpful to us as tax professionals, and then through that to you as our clients, can really just give us the tools and the information that we need to help to make sure that we're preparing your return accurately, which, in the end is good for everybody. So if you have any questions on how to set that up, I know we've sent some newsletters out, but certainly feel free to reach out. We're more than happy to do what we can to help you get that set up and moving forward. But with that, that is my presentation today. I know I put a lot of information into a relatively short period of time. I think we can all agree with Albert that income tax is definitely up there in a difficult topic to understand. And certainly when you add to it all of these legislative changes and things like that, it certainly becomes even more difficult. So I wanted to give a little bit of time here. Again, I apologize for running over. I had a lot to say today, I guess, but are there any questions or any discussion, any points anybody would like to bring up?
I would definitely reiterate to go get a tax account. I think they've taken off the Face ID requirement thing, but I've seen that save people a ton of time. I mean, if you need transcripts, or in a lot of cases, people are receiving notices that are outdated, and you can go onto your online account and see right away that, oh, no, it's already taken care of. So one of the better resources that the IRS has, especially in these times, and for all your stimulus payments, everything on your account, it's right at your fingertips there. So definitely try to get that if you can. You can also get an identity protection PIN if you do that, and then you'll have a PIN that only you can file your tax return, which is optional, but often recommended. So
that's a really good point, Lucas. And yes, they have made some changes, or they plan to make some changes to the ID.me. That was the identity verification service that the IRS had started to implement using to verify people's identity in order to get their taxpayer account set up online. And it has since met against some pretty strong feelings and will no longer be being used. I checked it last week and it was still part of the website if you were to go to set up a new account, but I'm not sure if it still is. But at some point we do anticipate that that part of the system will go away. So. All right, well, if there's no other questions, I think it's safe to say that the IRS challenges and disruptions are probably likely going to continue for tax season 2022. All of the laws and the regulations, especially for state and local taxes and federal government as well, those are all going to continue to evolve. And the lingering pandemic and a lot of other, economic factors, inflation, unemployment, things like that, all of those are certainly going to have impacts on future tax and legislative changes. So there's a lot of change out there. There's a lot of things that are happening, but with that change, we do believe that there's certainly a lot of valuable opportunities that businesses and individuals can take advantage of as a lot of these tax law changes come to fruition. So, at the end of the day, we are here to help, and we're doing the best that we can to monitor all of this moving information and moving pieces, and we'll definitely keep providing updates as we can and as the information becomes available to us. So thank you everybody for attending. Really appreciate your time.
Thank you, Bethany, for your insight. Really, really well done. There's obviously a lot to take in here. I want to thank everyone for attending tonight, and we hope that you found it insightful. For those of you who would like to reference this presentation in the future or share it with somebody, the full presentation and video will be accessible on our website, if not by end of day tomorrow, certainly by Friday. Of course, as Bethany said, we are here to serve you. And if you have any questions at all, please don't hesitate to reach out to Bethany or anyone on our team. And thank you so much, folks, for joining us tonight. And I wish you all a very nice evening and happy tax filing season. Bye-bye.